All right, welcome everyone. Thank you for joining. We're going to go ahead and get started. So today we are reviewing the YCharts Economic Summary Deck, a closer look at Q1 2021. My name is Connor Kitko, and hosting today's webinar with me is Rushi Shah, a product manager here at YCharts. Should you have any questions for us throughout the webinar, you can submit those on the left-hand side of your screen, and we'll be following up with the info you're looking for shortly after today's event. Finally, as always, we will be posting a recording of this webinar to the support topics page in YCharts. In the tool, if you click support and then support topics, you'll find the deck there. And we'll also send out a copy to attendees via email. Now, one of the great things about this deck, why a lot of YCharts clients love it, is that once you download it from the platform, you can customize it with your own logo, your own colors, your own commentary. One quick note on that, though, for some of you listening, is that the deck is not FINRA reviewed. And so you should please work with your compliance teams before sharing further if that's relevant to you. And now I'll pass it over to Rushi to get us started here.
All right, thanks, Connor, and thanks for everyone for joining today. Really excited to cover this Econ deck. Connor and I have done it in the past, and this is one of our better like presentations or things you can find in the support menu because it gives you a nice summation of the whole quarter, everything that's happened in the markets and the economy, and just some interesting visuals that you can grab from YCharts. Whether you need our help grabbing it or not, a lot of this information is just available on the tool. So let's go ahead and get started and look at some of this data. So just overall stock market performance, and these slides to start the presentation really just covered the markets in general, what happened in the US markets. Most notably, you could see the Dow Jones, the S&P 500, and the NASDAQ composite here at the top. And then at the bottom, you can see some MSCI international indices to get an idea. This quarter was an interesting one. I mean, we had a lot of crazy things happen already this year. Even if you thought 2020 was crazy, it hasn't ended this year. So, to start off, I mean, we saw the Reddit GameStop craze and what that happened, what that caused in the markets. And after that, I think the biggest headline was interest rates and the rise there and what the Fed policy was going to be. Just looking at the slide here, you can see overall the markets were positive. You saw tech lagging a little bit based on some sector rotation, and so that's why you're seeing the NASDAQ composite a little lower at 2.95% compared to the Dow Jones increasing around 8.29% and the S&P around 6.17%. Internationally, stocks mostly performed slightly positive over the quarter as well. Emerging markets were up nearly, around like, I think it was 13 or 14% at one point. So it retracted since then, but still positive on the quarter. Moving on to the next slide, we kind of cover the sector performance. So you'll see we break it down by cyclical, defensive, and sensitive sectors. And the highest performing sector, surprisingly, to start the year off was energy, having over a 30% total return. And you'll see the lowest ones were sectors like consumer staples, and technology was down there too, but overall positive across the board here. Another notable event that we wanted to highlight in this Econ deck was the S&P 500 reaching 4,000 for the first time as we trace around all-time highs here in the markets. And we thought it was really interesting that when the S&P 500 went from 1,000 to 2,000, where it doubled, it took about 16 and a half years to do that. You could see in the chart, we have the recessionary periods highlighted here in gray. And that was a time when there were two recessionary periods, which is likely why it took longer for the market to double. This time around, though, even going into a recession that we're in right now, it took only 6.5 years to double from 2,000 to 4,000. So, Connor, any bets on the next double to get us to 8,000?
Oh man, I'm a little nervous about this one, especially because you called out the gray recession shading here to see that we just keep setting new highs inside of that gray bar. Um, I'm going to say more than 6.5 years for sure till the next doubling. I'll take
Yeah,
the over.
definitely. I think I'm with you on that one, but I guess we'll see. All right, well, next we're going to move into asset class performance.
Yeah, so here's good old reliable asset quilts. If you've watched these decks, if you've looked at this deck before, you know this one. It shows performance for different asset classes over trailing periods. And on the left-hand side of this table are our shorter-term trends in performance. And on the right-hand side are the longer-term trends. I'll quickly note that the first and third columns here, which are the year-to-date and 3-month performance figures, are identical because obviously, this is a report as of Q1 2021. But my main takeaway from this slide is the difference between those short term and the longer term periods, like I mentioned. Over the last 3, 5, and 10 years, assets like US stocks, particularly growth and small cap stocks, have been strong market leaders that whole time. But then looking in the short term, we see the picture is changing pretty significantly. You can jump to the next slide, please, Roosh.
Yeah.
So here we've got the same performance data on the previous slide, same asset classes, but we're looking at this quarter by quarter versus those 3, 5, and 10-year trailing periods. So we see a lot of the same trends, but maybe not quite as dramatic here in the quarterly view. And I personally think this asset quilt, is a great visual to answer any questions about the value of diversification. So over the last few years, even assets like muni bonds and US Treasuries have led the market in some quarter. Uh, Once again, making a case for holding a lot of different assets in your portfolio. Rushi, could you quickly jump into YCharts just to demonstrate where everyone can get this data from? Because we make it so easy to export this data from YCharts. If you just click Tools and then go into Time Series Analysis, anytime you're working with large amounts of data, especially if you want to export it from the tool, Time Series is a great place to go. And then Rushi, if you click where it says New Time Series Analysis Unsaved, and then click New from Template, we'll see a few templates in here that we created to get you all started. And actually, if you just click on that quarterly returns, and then the very first one, major asset class quarterly returns, with just a few clicks, no entry, no use of the keyboard at all, we've got this trailing period returns for all those asset classes we were just looking at. And of course, you can export this into Excel. Rushi, if you hover over that export, you can export the data, the hard data, or if you're using our Excel add-in, you can export using the add-in, and this data will automatically update every time you go back into that Excel workbook. So very easy if you want to check back on the assets mid-quarter or next quarter, time series analysis is your place to go.
Yeah, and I'm glad you mentioned the templates, Connor, because if you haven't seen this, this is a relatively new tool that we've added, and it's not only in the time series, but in a lot of the tools across YCharts, where you can just grab pre-canned templates that we found were the most used templates on YCharts, and so we have those ready for you so that you don't have to go through the work of actually creating them.
Awesome.
All right, and then another thing, Connor, you mentioned that I thought was pretty useful was the value of diversifying your portfolio, right? And that's what we wanted to talk about in this slide here. So we used our model portfolios tool, which we'll get into a little bit more in a later slide, but we made these different risk buckets. So you'll notice here we have one that's aggressive, one that's balanced, and one that's conservative. And if you're an advisor, I'm sure you got the questions last year of, what's happening with the markets? Is my risk correct? Like, why is my portfolio dropping so much back in March? Well, this slide is great to kind of have that conversation and mention, if you are really aggressive, then naturally, more risk means your drawdowns are going to be larger, and less risk means that your drawdowns are going to be less, but your returns are also potentially going to be less, or your return potential. That's what we have here. So we have overall from starting back at the bottom in March 23rd all the way until today, you'll see that the S&P 500 actually made a huge comeback because the market was at its bottom and it grew around 56% after that. And you'll see as you get as you get more and more conservative, that return's going to be down or lower. But towards the bottom, you'll see it's a percent off high chart. So this is one of the settings you can adjust in the fundamental charting tool. And you can show the actual drawdowns that occur for each of these model portfolios and the markets in general. So you'll see in July, we had a little bit of a drawdown. You'll see the S&P 500 is down much lower than the other model portfolios. And you can kind of have that conversation with your clients through this visual. So a great example of risk versus reward.
Yeah, and really quick, we will show some of that percent off high charting later today as well. So stick around if you want to see that. Um, this next chart looking at interest rates. So expecting this will bring about some mixed reactions. If you're overweight financials, then maybe you're smiling right now. Give yourself a pat on the back. But if you've got a lot of exposure to longer term treasuries, then perhaps you're less excited about this chart. The yield curve has gotten very steep very quickly. We're looking at the current, or as of the end of Q1, the yield curve was that green line on our yield curve chart here. This is due to rapidly rising long-term rates as kind of the economic outlook starts to turn more positive. And then also the Fed's commitment to keeping short-term rates at zero or near that level. So a steepening yield curve is typically a bearish signal. However, adding some historical context, perhaps because rates are so low by historical standards, we won't see the same extent of credit tightening or firms having a hard time accessing capital. And perhaps, once again, just speculation, that steepening won't be as much of a concern this time around. And as somewhat of a proof point, we just see that stocks continue to go higher, maybe a little bit more turbulence in Q1 2021, but still setting new highs. But keeping an eye on the yield curve is definitely a good idea. As you can see, it's changed dramatically over the last few months.
Yeah, and I think that's a great transition into this next slide, Connor, where we kind of cover those early reactions to those rate changes. So you just saw the yield curve, and this is more about some other parts of the market that are being impacted by those changes. So one that's most notable and one that's hitting the headlines a lot has been just the overall supply and demand in the housing market and just mortgage rates and where they're headed. So this chart on the left covers rising interest rates and what's happening to the overall existing home sales. So when we were towards record lows, which we hit in mortgage rates in January, you could see the overall U.S. existing home sales was near an all-time high or near a high at least on this chart. And you're seeing that it's kind of dropping off after that. So as those interest rates are rising, as mortgage rates are getting higher, maybe that's a reason why this home sales number is dropping off, or perhaps it's kind of a supply and demand issue. On the right, kind of shifting gears into just overall duration of bonds, you'll see that the performance of these iShares ETFs and just you'll look at the short-term performance and it's relatively flat versus that long-term performance has really dropped off over time, and towards the bottom here you'll see the AUM as well has dropped off in that longer-term ETF. So kind of gives you an idea of what investors are thinking in terms of duration on these bonds and what they're positioning their portfolios into in terms from a fixed income perspective.
It's interesting to see, as you know, we had a pretty quite an event last year, but now it's kind of saying people are backing off from long-term treasuries, assumedly a safer asset, but pretty interesting action and reaction there.
Yeah, definitely.
Cool. So looking at some leading indicators, and I'm realizing not sure if Rushi's jealous, but I got all the colorful slides today.
Yeah, you
Another
did.
another quilt to look at here, but we won't spend too much time on this slide. But what we have here is a few of the key leading economic indicators. Unlike lagging indicators, some examples would be GDP or consumer price index, employment data. These leading indicators are considered to be more predictive about what the economic conditions in the near future will be or will look like. So retail sales, consumer sentiment, housing activity, and manufacturing data all trended upwards in the last quarter. Very good signs for an economy that's becoming more healthy. And revisionary data for prior periods. If economists love revising old data when no one's looking, but those revisions have been generally positive. So this is another indication that the economy and the recovery are perhaps stronger than originally reported.
Yeah, that's great. All right, moving along. So this next slide, if you're not familiar with a lot of the economic data that we have on YCharts, we strive on just adding data that's going to be valuable for your client conversations. And we know advisors got a ton of questions about the coronavirus data in general, where the markets are headed, how their portfolios are impacted by coronavirus cases and the vaccination progress and all of that. So last year, we added coronavirus case data and death data and a few other indicators for the world and also for individual states. And I can show you in YCharts where you can find that data. We also, this year, we knew the vaccination progress was going to be huge. So we added vaccination data for global countries and also the US states. So you can view where that progress is and how these numbers are changing, and also connect these numbers to the markets in general as well. So here on the left, you'll see the overall US total vaccinations, cases, and deaths over time. So you can see that we passed, some of these numbers are grim, but luckily they're a little flatter than the overall vaccination progress, which is what this visual is trying to show. And you can see when the overall US people that were vaccinated kind of crossed over that case line and crossed over that death line. And it just kind of puts a positive tilt towards where we're headed and just shows that progress that we have so far this year. And then on the right, you just have more of like a per day basis on these metrics. So you'll see that the overall cases per day are slightly trending downwards, whereas the overall vaccinations administered per day is trending upwards. So we hopefully will continue to see that over time here going into the summer. So if I go back into YCharts, and you could just actually search for any of these data points. So if I want to, we're based in Chicago and I want to look at Illinois cases per day. As you search that in that top search bar, it'll pull up that data point and you can go right into it and view that data over time. So I tend to have an eye on this type of data specifically for Illinois. However, we also added some templates like we talked about earlier in the time series. So if I'm in fundamental charts and I click on new fundamental chart here in the top left, you'll see that new from template is right here as well. So I'll click there and you'll see these different categories that we have. So we've had some notable webinars and we have those charts in here that you can access. You can access just overall asset class economic data charts. But down here at the bottom, we have vaccine and case data. So I would highly recommend clicking through this and just kind of looking at some of the different pre-canned charts we've made. That way, again, you don't have to make these on the fly. You could just click into these and really understand what a template is showing. For example, this one is the vaccine stocks performance. So you can see those three big names that are always in the headlines. You could see their stock performance as well as the overall vaccinations administered per day, just to keep an eye on this data overall.
Yeah, and these are great for like if you're putting out a quarterly update or a newsletter out to your clients, all these templates are great to just give that, broad market perspective or here's what's happening with the coronavirus situation this quarter. We see a lot of clients using the templates for that purpose.
Yeah, exactly. And you can brand these. You can kind of, just put a title on it, add some comments in here. If you send us your firm logo, we can add that in there. There's all sorts of things you could do within this to just make it more presentation friendly for you. And then moving along to the next slide here, we cover the sectors hardest hit coming back as the economy reopens. So if you've seen some of our marketing content around this, these have been really closely followed industries because it's what really got hit back in March. It was the things that are leading to traveling and just consumer companies. So these are notably called the beach stocks, and you'll see we have booking, entertainment, airlines, cruise lines, and hotels. And you can just see overall the progress from that March low and the huge uptick we're seeing in a lot of these industries this quarter as we're seeing things reopen. So you'll see this entertainment ones is kind of funny because of the AMC craze that happened with GameStop in January, but the rest of them you can see as well have grown quite a bit since that time, and most of them have outperformed, or all of them have outperformed the S&P 500 since that March low too. So they might have seen the biggest drawdowns, but they're seeing the biggest comebacks as well. I'm also personally very excited that the parks are opening. I'm a big fan of Disney and Universal Studios. So I don't know if you have any trips planned there, Connor, but I'll try and plan some this summer for sure.
I love the wizarding world of Harry Potter is magical. It is magical, to say.
Definitely. But just kind of going back into these industries. So the way we created this chart is we used our model portfolios tool. And a lot of people think that the model portfolios are great for that risk assessment, which we covered earlier, but it's also a great place to just kind of use as your sandbox, if you will, or just a spot to test out different industries, different buckets of stocks or funds, and really understand what the risk and return or the breakdown of asset class is in those different model portfolios. So I'm just going to jump into one of them here that I have, for example, the booking company one. So if I go down to my model portfolios, you'll see that I have this, and it's going to look like any other security or ETF that you're looking at on YCharts. You'll see data overall and just performance. Then you'll see those holdings here. So you can see that this model portfolio in particular is made up of these four booking companies. And you can understand the return versus your benchmark. You can understand risk. And just overall like sector breakdown, things like that, and do a whole lot else here as well. So it's a great tool to just kind of test out different strategies or make different buckets of securities within the tool.
Yeah, I like how you said sandbox, Rushi. I think that's a good way to put it. You just come and play around for a few minutes and build something out and see what happens. It's a good tool for that.
Yeah, definitely.
Great. So moving on, not quite as flashy of a topic, but global trade with the U.S. and some of our key partners. So on the next slide from this one, we will see kind of how this trade situation may have affected, to some extent, the US dollar and Forex rates. But for right now, looking just at trade, the top left chart illustrates how international trade has bounced back in the last few quarters from, Q1, Q2 of last year, with both US imports and exports reversing on their sharp decline that we saw last year. However, looking at the top right chart, this shows us that the trade deficit is increasing once again. Post 2008, after the '08 crisis, the US became much more of a producer and was importing less goods. But it seems that this time around, with this COVID induced recession, it's had the opposite impact on our imports and exports balance. It's an interesting chart right there, how we went back to that bottom that was set back before 2008 in terms of a trade deficit. Looking at the table at the bottom here, I'll call out the year-over-year growth in both imports from and exports to China. So looking in the three rightmost columns there, you can contrast that with our EU-based trade partners, where the recovery has been, notably slower, so not as much of a uptick and actually a decline year over year in trade. We can jump into the next slide from here, Rush. So what does that situation mean for the US dollar? The dollar is still overall weaker than it was a year ago, but it has picked up a lot of ground in Q1 of 2021 against some of these key international currencies. Now, the chart at the top with our orange, blue, and green series there, the dollar is still overall weaker than it was a year ago, as said, but it has picked up a lot of ground. Now we're looking at the dollar in green, and the dollar over that trend where it was weakening, and consumer price index, which is in that orange or red series, was rising. We see that the combined effect of those two was a diminishing purchasing power for US consumers, which is in blue. And so this kind of ties into some of the inflation things that we've heard about, but we just see that the purchasing power of the US dollar is going down as an effect right now. I'll pass it back to you, Rishi.
Yeah. Yeah, thanks, Hunter. This is a great visual, just overall showing all those exchange rates as well. I think it really puts the dollar into perspective and something that you can easily have a conversation with anyone with using these visuals. But moving along to the housing indicators. So we talked a little bit about housing and those reactions to interest rates in Q1. And there are some interesting takeaways here on this slide. So looking here in the top left chart, you can see that mortgage rate, the 30-year mortgage bouncing off of those January lows. However, you're seeing mortgage originations continue to go higher, which is interesting. We haven't gotten that latest number yet, but I would have to imagine with that mortgage rate increasing, we're going to start seeing this kind of top off and maybe drop off a little bit. But a lot of people are refinancing. So you could see these mortgage originations, about 67% of those are just simply refinances. So maybe it's not a conversation about people moving into new homes or buying new homes, but more so just taking advantage of those low interest rates and kind of being a no-brainer to refinance. And with that as well, you'll see here on the right that it's just the overall sentiment of housing, and you see that huge drop off back in 2020 where that sentiment overall dropped off, and now it's come back to strong levels, and even some of these lines are higher than they were before. So overall, the market seems to be pretty positive and upbeat in regards to housing, and these visuals kind of prove that. Down here below, we just have some of those different indicators that we have available on YCharts and just the trends overall. So you can see things like US new single family houses are kind of dropping off, and you could see those numbers already. However, there's some other metrics on here like housing starts that are increasing. So really interesting time right now with housing in general. And this chart as well just kind of really brings home the point of that supply and demand structure that we're seeing here in Q1. So overall, that housing supply has been dropping off and at the lowest levels that we've seen this whole basically since 2000, right? So it's really starting to show, and I've had conversations with a ton of people looking for new homes or moving because of this new work from home movement that we're going into, and people are just having struggle finding homes because they come off the market so quickly and that supply is so low. So it'll be interesting to see where things go from here. And overall, just home sales have dropped off like we talked about. So we'll see where we head from there as well.
Yeah, kind of anecdotally too, Rushi, hearing a lot of, houses moving off the market quickly and also a lot of bidding wars to actually secure those houses. So it becomes a little harder financially to make that transition happen as there's everyone rushing in at the same time, you know.
Yeah, and in our office we have a ton of people that are at that age now or at that time in their lives where they want that first single family home, and it's not as easy as it used to be 5 or 6 years ago. And we've definitely heard some stories from our office employees as well.
Yeah. All right. This economic recovery trend slide and this recovery chart here is one that we have kept coming back to a few quarters in a row here because it really easily tells us which aspects of the economy have recovered from COVID-19's initial effects and which ones are still off of their recent highs, uh, and to what degree they are off their highs or have set new ones. So this is a percent off high chart, like Rushi mentioned earlier. And we can see that the stock market, personal earnings, GDP, housing, and retail sales are all back to setting new highs up near the top level on the chart. And only employment is below its pre-COVID levels. Thankfully, it continues to trend in the right direction, but this is a good slide to talk about. If you remember back in 2020, a lot of the narrative was the stock market was recovering, but the economy hadn't. And this visual, puts that into context a little bit better. Rushi, if you could jump into YCharts, I'd love to show just how to use that percent off high feature and how to recreate that chart we just saw. So this is a chart, and we've already added all of that data that we saw in the slide, but it obviously looks a little messy because we're working with a lot of different y-axes here. But if Rishi clicks under data format, the percent off high feature, this is that drawdown chart that we alluded to, and it puts everything on the same terms, percent off of its most recent high. And then furthermore, if Rishi clicks annotate there at the top, maybe an easy one just for the S&P 500, Rishi, if you could click an annotation for the minimum line and apply. So now we see that dotted line appears on the chart. And if Rishi switches over to presentation view, he can add a title, he can add a description, and this chart is easily exportable to go into a newsletter, onto your blog, social media. Very easy to turn it into a visual and distribute that on whatever channels you'd like to. So wanted to show you a quick how-to on that one.
Yeah, thanks for that, Connor. All right, so moving along, on this chart here, we have the employment situation. And Connor, you alluded to it a little bit about employment kind of making that comeback. And this chart just breaks down the main headliners in employment. So you'll see at the top, we have that headline US unemployment rate, which a lot of these lines, they hit these crazy levels in 2020 and now are reverting back to normal levels. So 6% is where we're at right now in terms of unemployment. That U6 unemployment rate, which is calculated a little bit differently, is at 10.7. And then you'll see a few more indicators here at the bottom. But yeah, like I was mentioning, these numbers are coming back to normal levels after those March extremes. So hopefully the trends continue in that direction.
Yeah, fingers crossed.
Yeah.
And speaking of, if more people have jobs, then more people can spend their money to stimulate the economy further. So this next slide, aptly titled "Consumerism," what's more American than consumerism? But mostly everyone's talking about the reopening in very broad terms. So this slide gets a little bit more specific about exactly where Americans are spending their money and their stimulus checks, their stimmy checks, if you will. And this first green row on our table, U.S. retail sales in the units is millions of dollars. It shows that number has been increased somewhat consistently over the last couple of years, which is good to see, and a slight disruption in 2020 due to COVID-19, obviously. But the percentage of those dollars that is going to different types of goods has shifted somewhat. So auto sales are taking a larger share of consumer spending, as are building and garden supplies, going back to the housing slides from previously. Building and garden uh, both fit into that narrative pretty nicely. However, food and beverage and department stores are seeing less demand from consumers as of late. One quick note on e-commerce sales. Unfortunately, the Census Bureau won't be reporting that number until mid-May. And Rushi and I, we left our crystal balls back at YCharts HQ, so I won't try to throw out a number there. But maybe you can use your imagination to think what percent of total U.S. retail sales were spent online.
I'd imagine it's a larger number, but we'll see, I guess.
Yeah, just don't want to, lead anyone astray there. So we'll leave it up to your imagination.
All right. So along with that consumerism, a lot of people are getting money from the government to help them do what they like to do, or at least afford to do things that they're used to. And that's been a lot of the dialogue over the last year. How did the government respond? These stimulus checks that you just mentioned, Connor, they're definitely going to have some type of impact at some point, and you're starting to see the different measurements of the government in terms of debt and treasury outlays and things like that showing up in these economic indicators. So within this slide in particular, we have the overall outlays, and you'll see that most lately it's at 927 billion at this point. There's also an increase in U.S. public debt, and this is going back to around 2012, and you're seeing that it's been slightly increasing, and then right in 2020 we saw a big jump there. So debt is increasing, and also just the overall expectations of what debt's going to grow by. It definitely increased in 2020, and we're seeing another upbeat increase right here in 2021 as we're seeing more and more stimulus come into the economy. The chart here on the right just simply shows that percentage change of these numbers, so it gives you an idea of the overall, like how big that percent change is in these numbers, and it just kind of puts it into perspective overall.
Yeah, and to make this slide really relevant, Rushi, under the Biden administration, we know the talks of a lot of spending on transportation and education and continued COVID relief. And then on the other side of the government balance sheet, looking to increase capital gains taxes for the most wealthy Americans. So a lot of potential developments this year for both government tax revenues and spending.
Yeah, definitely. It's interesting to see, not only did we have the whole pandemic, but we also had a shift in from a political standpoint, and it's definitely going to impact the economy in different ways.
For sure. Okay, we'd be remiss to not mention one of the most newsworthy topics of early 2021. And I'll just quickly mention Rushi talking about cryptocurrencies and related assets here. Similar to what you mentioned about coronavirus data, back in early 2018, I believe, just based on the fact that a lot of our clients were getting questions from their clients, what about crypto? What about Bitcoin? We were able to add a really substantial and robust crypto asset data set to YCharts. So just another way that we're constantly adding data that helps you answer questions. Jumping back to the slide, this just really illustrates the continued strength and interest in cryptocurrencies from all sorts of investors. So the two largest cryptocurrencies, Bitcoin and Ethereum, they continue to grow, and investors are apparently still looking for exposure to these crypto assets as the exchange traded products that track them continue to see significant asset growth there given by those grayscale Bitcoin and Ethereum trusts. As of the very recent past, Bitcoin has sold off from a little more than $60,000 per Bitcoin. Currently is just over $50,000 per Bitcoin. And then Ethereum has shot straight up more than tripling in value year to date, and as high as a little over $2,300 per Ethereum coin we saw in the last few weeks. So as the performance continues to go up, we kind of anticipate more interest continuing to follow. But as a lot of advisors or wealth management professionals have some hesitation about, the long term and to what extent this is really viable to include in investor portfolios.
Yeah, that's great, Connor. Thanks for sharing. We'll see what happens with cryptos moving forward, but a lot of headlines and a lot of regulations coming with it, so it'll be
Yeah,
interesting for
exactly.
sure.
Yeah.
And I think that wraps up the slide. So, just thank you all so much for joining us. We hope this recap helps you with some commentary around the slides. Like we mentioned earlier in the slides, you can access this Econ deck by going to the support section and going into the presentation resources, or the resources section in particular. And that's where you'll be able to download that PowerPoint presentation. Remember, you can just download that and then you can make those edits as you please and add your own commentary in there if you'd like. So we hope you enjoy that. If you have any feedback for us on the slides in general or just the overall webinar, just please let us know, because we love to make sure that the slides are informative and help you with your conversations overall. So with that said, thanks, Connor, for joining me, and this was a lot of fun, and I hope all of you enjoyed it, and thank you for tuning in.
Thanks, Rishi. Thanks, everyone who's listening.